Ever wondered how the rich keep getting richer while the rest of us struggle to keep up? The secret might lie in the magic of compound interest. Now, you might be asking, what exactly is compound interest? Well, it's a simple yet powerful concept. It's essentially earning interest on your interest. Think of it as a snowball rolling down a hill, gathering more snow and growing larger with each roll. Let's break it down with a simple example. Say, you have $1,000 that you invest at an interest rate of 5% per year. At the end of the first year, you'll have earned $50 in interest, giving you a total of $1,050. Now here's where the magic happens. In the second year, you're not just earning interest on your original $1,000, you're also earning interest on the $50 you gained in the first year. So at the end of the second year, you've earned $52.50 in interest, bringing your total to $1,102.50. This may not seem like a huge amount, but imagine this process repeated over 10, 20, or even 30 years. The amount you earn in interest starts to dramatically outpace the amount you initially invested. That's the power of compound interest. But here's the key. Compound interest is a long-term game. The longer you leave your money invested, the more time it has to grow. It's not a get-rich-quick scheme, but rather a get-rich-slowly strategy. It requires patience, discipline, and a commitment to consistent investing. In a nutshell, compound interest enables your wealth to grow exponentially over time. It's the secret weapon that many wealthy individuals use to build their fortunes. And the best part is, you don't need to be a financial wizard to use it. With a bit of time and patience, anyone can harness the power of compound interest. So you see, compound interest is not just a financial term. It's a powerful tool that can transform your financial future. Now you might be thinking, I get it, compound interest is great, but where do I get the money to invest? Good question. Let's explore some answers. First and foremost, let's talk about savings. Saving money isn't always easy, but it's often the first step in building up investment capital. Start by setting aside a small amount from your paycheck each month, and before you know it, you'll have a nice little nest egg to invest. Next, consider cutting down on unnecessary expenses. You'd be surprised at how much you can save by making small changes in your lifestyle. Maybe it's that daily coffee from a fancy cafe, or perhaps it's the premium cable package you rarely use. Whatever it is, identify these expenses and trim them back. You'll find that the money you save can go a long way in your investment journey. Another strategy is to acquire a side job. In this digital age, there are countless opportunities to earn extra income. From freelance writing to virtual tutoring, there's likely a side gig out there that suits your skills and interests. Not only will it supplement your income, but it could also open doors to new experiences and opportunities. Selling unused items can also be a great way to accumulate investment capital. We all have things in our homes that we don't use or need. Why not turn those items into cash? There are numerous online platforms where you can sell everything from used books to furniture, and the proceeds can be used to kickstart your investment. But I don't have a lot to start with, you might say. That's perfectly okay. Remember, the beauty of compound interest lies in growth over time. Even small amounts, when invested wisely, can grow into substantial sums. The most important thing is to start, and start now. Don't wait for the perfect time or the ideal amount. Every journey begins with a single step, and the journey to financial freedom is no different. Remember, the journey to financial freedom begins with the first step. Start small, but start now. So you've got your capital and you understand the power of compound interest. Now, where do you invest? There are several strategies you can consider. Let's start with stocks. These are essentially shares of ownership in a company. When you buy a stock, you become a shareholder. If the company does well, your stock increases in value. But remember, the opposite is also true. If the company doesn't do well, the value of your stock decreases. Stocks have the potential for high returns, but also come with high risk. It's a bit like rolling the dice, but with a bit more strategy involved. Next, we have bonds. Buying a bond is like lending money to a company or government. In return, they agree to pay you interest on your money and then pay you back the principal amount at the end of a set period. Bonds are generally considered to be lower risk than stocks, but that means they also usually offer lower returns. Think of bonds as the tortoise in the race, slow and steady. Then there are mutual funds. A mutual fund pools money from many investors to invest in a diversified mix of stocks, bonds, or other assets. They are managed by professional fund managers. Mutual funds offer diversification, which can reduce risk, but they also come with fees that can eat into your returns. Mutual funds are like a buffet. You get a bit of everything, but you pay for the service. We also have exchange-traded funds, or ETFs. They're similar to mutual funds, but they can be traded like stocks. This gives you more flexibility, but like mutual funds, they come with fees. ETFs are like a buffet too, but with the flexibility to come and go as you please. Choosing the right investment strategy depends on your financial goals and risk tolerance. There's no one-size-fits-all approach. Diversification is another key strategy in the world of investing. It's the classic "don't put all your eggs in one basket" advice. Now, what does that mean exactly? Well, diversification is a method used to manage risk by investing in a variety of different assets. And when we say different, we mean different. This means you're not just investing in different stocks, but also in different types of assets, such as bonds, real estate, and even commodities like gold. This way, if one type of asset or one particular investment doesn't perform well, you have others that may offset the loss. But how do you effectively diversify your investment portfolio? Here's a simple rule of thumb. Don't invest more than 5% of your portfolio in a single security, and don't have more than 20% in any one sector. That said, diversification is not a one-size-fits-all strategy. It depends on your financial goals, your risk tolerance, and your investment timeline. If you're saving for retirement and you have a couple of decades ahead of you, you might afford to take on more risk and invest heavily in stocks. But if you're nearing retirement, you might want to be more conservative and shift towards bonds and other fixed-income investments. Now let's talk about the benefits of diversification. First off, it can help smooth out the ups and downs of your portfolio. It's like a financial shock absorber. If one investment falls, others might rise to soften the blow. Secondly, diversification can potentially enhance returns. By investing in a variety of assets, you're not just limiting your risk, but you're also increasing your chances of hitting upon an investment that performs exceptionally well. However, it's important to note that while diversification can help manage risk and potentially enhance returns, it doesn't guarantee profits. There's still a level of risk involved in any type of investment, and remember, it doesn't protect against loss. However, it's a crucial tool in your investment strategy toolbox. Diversification can help manage risk and potentially enhance returns. But remember, it doesn't guarantee profits or protect against loss. We've covered a lot of ground today, so let's take a moment to summarize what we've learned. We kicked things off by unpacking the power of compound interest. It's a magical concept indeed. Compound interest is the process where the interest you earn on your investment starts earning interest itself. It's like a snowball rolling down a hill, growing bigger and faster with each rotation. It's not about making a quick buck, but about the incredible growth that can occur over a longer period. So remember, it's not just about saving, but about saving and then earning interest on those savings and then earning interest on that interest. Next, we delved into understanding investment capital. We learned that this isn't just money stashed under your mattress, but money put to work. It's about making your money work for you. We explored ways to get started on acquiring this capital, from cutting down unnecessary expenses to taking up a side gig, or even investing in your education to increase your earning potential. Every little bit that you can spare can be invested for future growth. Then, we moved on to investment strategies. We discussed the importance of diversifying your investments. Don't put all your eggs in one basket, but spread your investments across different types of assets. This helps to reduce risk and increase potential gains. We also talked about the power of patience in investing. Rome wasn't built in a day, and neither will your wealth. It takes time for compound interest to work its magic, so resist the urge to cash in your investments at the first sign of profit. Finally, we highlighted the importance of regular investments. Instead of waiting for a large sum to invest, start with whatever you can and keep adding to it regularly. This strategy, known as dollar cost averaging, can help smooth out the highs and lows of the market. Remember, the journey to financial freedom is not a sprint, it's a marathon. Make compound interest your friend, invest wisely, and watch your wealth grow over time.